Good morning. It's great to be with you again. I hope you're all very well. So August was another solid month. Very, very welcome to have another solid month, but we move into September, and historically, over the last 10 years at least, September has been the weakest month of the year. And we do have quite a big US interest rate decision this month, so possibly we could have a bit more volatility in September than we've had over the past few months. So we'll look into that today. Plus, I have an exciting update on the plus funds, which I will discuss at the end. But first, let's have a look at what the markets did in August. Japan, the clear winner for the month of August, up 4% in Rand terms, which is very impressive because, as you can see by looking at the bottom bar, US cash, which is down -3%, that means the Rand strengthened by 3% during the month of August. So very unusual to have so much Rand strength in August, but very welcome. SA equities also up very nicely, up 3.5% for the month. China up 2%. So emerging markets, China, SA, all doing very nicely on the back of strong commodity prices and strong tech returns. The strong Rand did hide the translation of generally strong returns across all markets during the month of August. But you can see there that the US slightly negative on the back of the 3% Rand strength, and healthcare and US tech also down a little bit in Rand terms. But everything else up in Rands and in domestic currencies, in euros, in yen, in dollars, all the underlying funds having a great month in August, partly due to the small peace dividend we might have got out of the Russia-Ukraine war, although I think that's unlikely, and I'll discuss that as well. But also, I think the biggest driver was a very dovish Fed, and I'm going to talk about that in much more detail today because I think it is fascinating what's happening in the US around that interest rate decision that is coming in September. So looking at the top performing Sygnia funds for the month and for the year, no surprise, the Sygnia Itrix MSCI Japan Fund was number one, as can be expected. South African stocks in the second, third, and fifth place, just on the back of a strong Rand and strong commodity prices, which has driven our resources. I think our resource index is up 75% year to date. So very much only operating on one cylinder when it comes to SA equities, but a roaring cylinder that is, and that's keeping our markets up nicely, despite all the risks that the rest of our economy and our market is seeing. Very nice to see the Berkshire Hathaway Fund in the top five. That's been out for a while. In fact, I interviewed our head of thematic equities, Vessel, and discussed the Berkshire Hathaway performance because Berkshire Hathaway has had the worst 3-month underperformance relative to the S&P 500 in nearly 2 decades. And that was on the back of the results and the announcement that Warren Buffett was stepping down as CEO from Berkshire Hathaway. The bottom line of that interview, Vessel calls Berkshire Hathaway a strong buy, but please look out for our interview on Berkshire Hathaway. Very, very interesting. That fund, the Berkshire Hathaway Fund, has just reached the 500 million Rand mark. So certainly a strong favorite of many investors. So please, keep an eye out for that. Looking over 12 months, things relatively stable from last month. China still in the number one position with a really decent return, 43% return from the Sygnia Itrix MSCI China. Again, on the back of strong commodities, strong China stimulus, strong Chinese technology company movements. We had great results out of Alibaba this month, in fact, a few days ago. I'll also be talking more about China later on, and they definitely seem to be doing right things when it comes to stimulating their economy. FANG holding on as it does in second and third place, and then South African equities in fourth and fifth place. That's the top 40 ETF and the Sygnia top 40 unit trust. So nice to see some decent returns still out of South African equities.
President Trump taking aim at Goldman Sachs economists and CEO David Solomon in a Truth Social post yesterday, writing, quote, David Solomon and Goldman Sachs refuse to give credit where credit is due. They made a bad prediction a long time ago on both the market repercussion and the tariffs themselves, and they were wrong, just like they are wrong about so much else. I think that David should go out and get himself a new economist, or maybe he ought to just focus on being a DJ and not bother running a major financial institution. This in reaction, of course, to a note on tariffs from Goldman Sachs, the economics team led by Jan Hatzius, citing that U.S. consumers have absorbed 22% of tariff costs through June, but that their share will rise to 67% if the recent tariffs follow the same pattern as the earliest ones.
You have to love Trump. He is very, very witty. I had no idea that the CEO of Goldman Sachs is actually a DJ. He's got his own record label, as I suppose you can do when you are the CEO of Goldman Sachs. If no one wants to publish your music, then you just start your own record label. So he's known as DJ D-Soul. So keep a lookout for the Goldman's music when you are next on Spotify. But I do think that Goldman Sachs has got some very interesting research, and I do think that there are some serious headwinds heading towards the US on the back of that research. It certainly makes sense. So before I get into the details, I think it's important to look at the two charts on the right, or the table on the top and the chart at the bottom. So right now, where we are, if you look at the bottom chart, the observed tariff that the US is seeing is about 10%. So they're paying about roughly 10% duties on their imports. Now that's expected to double to about 20% by the end of the year, according to JP Morgan. The top table, I think, is more fascinating, and that's from Goldman Sachs. They look at June and they compare how that's going to be in October. And in June, they see that US consumers are only paying about 1/5, 22% of those tariffs. So they're paying 1/5 of the 10%, so that's roughly 2% of the tariffs. But by October, that's in a few months' time, they're going to be paying nearly 2/3 of the tariff, and that's going to be on 20%. So suddenly you go from a 2% cost to a 12% cost. That's a sixfold increase on tariff. So what is their thinking? Well, the main difference is US corporates. So right now, US corporates are paying the bulk of tariffs, 64%, according to Goldman's. But it looks like US corporates are going to start passing on those tariffs quite aggressively. There's two reasons to support that view. The first is just looking at corporate guidance. So we've had all the second quarter company results that have come out, and corporate guidance is pushing for enhanced and widening margins in US companies over the next 2 quarters. So margins aren't going to widen if they're going to start taking on those tariff costs. So they must be passing it on. Not only that, if you look at the July PPI number, which was the highest in 3 years at 0.9%, that PPI number is a very good proxy for US corporate margins. So that sticky high PPI number also confirms that US corporates are going to pass on those inflationary impacts of tariffs. That means that consumers are going to pay more, and that means inflation is suddenly going to spike. Now, what about foreigners? You might say, well, aren't foreigners going to cut their prices? So BMW might just sell their cars cheaper to avoid the tariffs. There's no sign of that so far. The dollar import price of foreign goods is level. So foreigners might actually be, well, some foreigners are actually cutting their prices, and I'll talk more about that later, but that's only to take account of their strengthening currency. So BMW is actually cutting its prices slightly because the euro is stronger, but they're not doing enough to offset the tariffs, and that's why foreign exporters are absorbing very little of the tariffs. 14%, according to Goldman's, likely to possibly increase a bit more if import volumes decrease. But the bulk is going to be paid by US consumers, increasing 3 times. Now, what's interesting is that sixfold increase is based on that effective tariff around 20%, which JP Morgan is estimating. So that is based on a number of things, but right now, if you look at the actual duties that are being collected, $27 billion of duties was collected in June. That's 4 times the average of 2024. So those tariffs are definitely being paid. It's not like they're being avoided. Scott Bessent estimates that tariff revenue will reach an annualized level of $1 billion by the end of the year. Now, if that's true, that means there's not going to be a sixfold increase to US consumers. There'll be a 9-fold increase because suddenly it's a much bigger increase in the tariffs that they are going to start accumulating. So that's means there's even more upside to these numbers. Now, that could be right because The effective tariff is excluding certain things, such as Trump has just ended the duty-free exemption for all parcels containing goods worth less than $800. I mean, that is a huge, I mean, goods worth less than $800 is the bulk, in terms of volume at least, of the imports. That affects all consumers, all small companies that are importing parts or whatever it may be to pass on to resale to consumers, wholesalers. That's going to increase tariffs quite significantly. Not only that, but the debate around tariffs, yes, we heard last year, we heard last week that once again, tariffs have further been confirmed that they are illegal, but they remain in place until the 14th of October, which gives Trump enough time to appeal at the Supreme Court. So I don't think those tariffs are going to go away. And even if they do, there are a number of other avenues for those tariffs to be put in place. So I think that we're going to see some strong inflationary increases come through later on, and that could unsettle markets in the short term and unsettle the consumer in the long term. Now, the big pushback from the Goldilocks camp is that tariffs are going to be transitory. Now, that is certainly a possibility, but on the other hand, I mean, tariffs started in April. They're slowly ratcheting up to December. Trump hasn't even stopped adding new tariffs on. So at best, it's going to be spread over 6 months. At worst, it's going to continue for the 4 years that Trump's in power. So to call it once off is, I think, being a bit too optimistic. But I will talk more about that when I get to the Fed.
When it comes to Fed Governor Lisa Cook, her lawyer has said that they're going to be filing a lawsuit challenging legal action. What is your response? Are you prepared for a legal fight?
Oh, sure. She always has legal fights. But no, she seems to have had an infraction, and she can't have an infraction, especially that infraction, because she's in charge of, if you think about it, mortgages, and we need people that are 100% above board, and it doesn't seem like she was. Yeah.
So Trump's saying that Cook has had an infraction. By that, he's alleging that she is guilty of fraud, and that makes her not 100% above board, and therefore she has to be fired. Ironically, Trump has been convicted of fraud, not just allegedly. He has been convicted of fraud, so might be a bit of a case of glass houses and pot kettle and all that. But regardless, he is trying to fire a Fed governor. Now, a US president has never fired a Fed governor before. So once again, it has brought Fed independence into question. You know, we've heard Trump trying to fire Powell many times over the past few months, and now he's trying to fire Cook. And so the dollar did weaken on this news because markets are rightly concerned about Fed independence and what that could mean for inflation and the dollar and all the indirect consequences that happen to markets. Now, why are people concerned? Well, because replacing Cook would secure Trump a 4-person majority in the 7-member board of governors. So this is all rather complicated, but when it comes to the FOMC, there are 12 voting members. 7 of them are core, and they stay each month. That's the board of governors, and Trump would then have a majority on that 7. The other 5 are regional Fed presidents, and they rotate each year, except for the New York president who doesn't rotate. But not only, so you might say, well, sure, he might have 4 out of 7, but there's 12, and that won't allow him a majority. However, next year, all 12, all the regional presidents are up for re-election. And that's the core members, the 7 members, the board of governors, they get to confirm those re-elections and decide who becomes a regional Fed president. So if he gets this 4 out of 7 majority, not only does it mean another handhold in the Fed, but it means actually being able to control all the regional Feds as well in the next year's re-election. So quite a big thing for Fed independence. And very interestingly, is the pressure on the Fed working? Because we had a surprisingly dovish Powell at Jackson Hole. Jackson Hole happening in August every year when the Fed puts together some research and they have a bit of a think tank and decide what their focus is going to be for the next year. Generally, some very interesting economic research if you like economic research. But more importantly was Powell's speech. So he said, a reasonable base case is that tariff effects will be relatively short-lived. He's not using transitory anymore, and a one-time shift in the price level. He also said, and the shifting balance of risks may warrant adjusting our policy stance. So the second part of that points to the dual mandate of the Fed. The Fed has to worry about inflation. If inflation is too high, you raise rates. And employment, if employment is too low, you cut rates. So that's what the Fed has to balance. So very dovish, saying, we're focusing on employment more than inflation, so we might have to cut rates, and we're not so worried about inflation anymore. Inflation is going to be short term. Now, why do I think that this might be politically motivated as opposed to the numbers? Well, we did have the huge revision in payrolls on the 1st of August last month. The worst revision or the biggest revision in 40 years. And it saw the head of that department being fired by Trump because he just said those numbers were not to be trusted. Trump nominated Antony, an economist, and Antony came out to say, well, we can't trust those numbers, so let's stop publishing them. So now all of a sudden you've got a Fed you can't trust, and you're not going to have any numbers being published. So it started to look more and more like China, and the markets, again, the dollar sold off. Fortunately, Antony backtracked his statement, and those numbers are going to come out. Why are they important? Well, interestingly, those payroll numbers are actually the biggest market-moving number in the US. Much bigger than interest rate decisions from the Fed, much bigger than inflation numbers that come out. So they certainly are important numbers. That said, let's look at that number. So if you look at that number in isolation, the revisions led to a 3-month rolling average, which was below 1%. So growth was below 1% over 3 months. And in the past, whenever that's happened, if you've had growth that low, a recession has appeared in the US. So certainly something to be concerned about. And maybe that's, on the surface, why Powell was so dovish and focusing now on employment. However, that was just one number in isolation. If you look at everything else, particularly the chart on the right, employment in the US looks relatively robust. Yes, it's not booming, but it's not at recessionary levels. And we certainly don't expect a recession in the US. And it's one of the reasons why we continue to be overweight equities and think that markets will continue to move up. So the chart on the right shows private layoffs and discharges, and that is below the pre-COVID levels. So still very strong. But I think probably the best number to look at is insurance claims. And that remains very, very stable. In fact, that also remains at pre-COVID lows. And why is that important? Well, that shows the number of people who are claiming insurance for being unemployed, whereas the employment numbers are also impacted by immigration. So if the US and Trump's policies on immigration are seeing fewer immigrants or seeing the lapse of visas, well, yes, then employment won't grow as quickly as you are expecting it to. But that doesn't necessarily mean that there's a problem if your supply is not growing. So as long as immigration is causing a decrease in supply of employment, if employment is not growing as much, well, then you're still sitting at a reasonably low unemployment rate, and that's what we are. The US unemployment is at 4.2%, below the Fed's level of 4.3%. So there's no need to really cut rates. The economy is doing okay, employment's doing okay. And if you look at all the other numbers, as I said, it's the layoffs and discharges are okay, claims and layoffs are okay, unemployment insurance is okay, hourly wages is okay, weekly hours worked is okay. The US seems to be okay. So generally, the US is doing fine, not heading towards a recession. It seems like Powell is the FOMC is going to cut in September. There are certainly some doves like Waller who are pushing for it. So we are more than likely to see a cut this month, which might keep markets going. And the market is pricing in a 90% chance of a cut. However, the market's also cutting in 4 cuts between now and January. I just can't see any more cuts. If we do cut, I think it's probably going to be the last one for the year as that inflation starts to feed through. And it's not just the tariffs, but if the unemployment is staying low because of immigration falling, and if the reason that employment is not growing is because of immigration falling, well, then we are going to see some wage inflation coming through because of that lack of labor supply. So we'll have a double whammy on tariffs. We'll have sticky wages and some tariff feed through, which will keep services and product inflation going through. So we'll see what happens. The big number is US CPI that comes out in 2 weeks, and it has surprised the downside for 6 months in a row. Well, we'll see what happens this month, but I'm putting my money on red this month, not on black. So let's watch and see.
I would like to thank once again my American counterpart. The proposal to travel out here to Alaska. It only makes sense that we've met here because our countries, though separated by the oceans, are close neighbors. So when we've met, when I came out of the plane and I've said, "Good afternoon, dear neighbor. Very good to see you. In good health and to see you alive."
Must be a Russian tradition that I don't understand, but good to see you alive sounds more like a threat than a welcome. But anyway, these two were together in Alaska, and we had a step towards the peace process in the month in terms of the Russia-Ukraine war. Now, it was a very small step, unfortunately, and if you look at the betting odds, the probability of a ceasefire agreement before the end of 2025 has fallen, actually, from before this peace agreement or peace meeting to afterwards, now down to 24%, down from 40%. And that's because of a number of things. Firstly, Putin has demanded that Ukraine surrender the Donbas region, and that means Zelensky has to put that to a vote, and we'll see how many people in the Ukraine want to give up that region. In addition, Putin has said that NATO cannot put any troops on the ground within the Ukraine. So although the US or Trump has agreed to some sort of security guarantee, that's going to be quite difficult without troops. So to be limited to arms, which they're already doing, or possibly some sort of air support, which again that hasn't been too limited from what's being supplied by the allies. So not too many steps in the right direction. So for now, when it comes to Europe, we aren't putting a big bet on the peace dividend helping EU grow. Now, the euro has had a really strong start to the year, and the EU stock markets, besides Switzerland, have also had a very strong start to the year. But I think that they may have run out of steam. So when it comes to the Eurozone for the rest of the year, they're facing some serious headwinds. The first is China. So China is now seeing restricted exports to the US, but they're seeing a weaker currency because their currency is pegged to the dollar. So their currency is not strengthening as much as other emerging markets and as much as the euro in particular. So all of a sudden, they are looking much more competitive against Germany for their exports, and they're seeing reduced markets. So it's highly likely that China is going to steal further market share from Germany and other European exporters, which will keep growth and inflation contained within Germany. When it comes to the new markets, the biggest gain in terms of market share from China's exports is actually Africa, which from our perspective, I suppose, shouldn't come as much surprise. We're definitely seeing a lot more Chinese cell phones and cars within South Africa than we have seen in the past. And apparently that is a growing trend within Africa. Secondly, import prices for consumer goods are looking to fall. If you look at the top panel in the chart on the right, you can see there that import prices of core consumer goods has turned negative, and implied import prices from China is also negative. And those goods make up 25% of the inflation basket. So pushing euro area closer to deflation and away from inflation. Similarly, ECB wage trackers, that's the middle panel, you can see that's plunged. So that means that wage inflation is also close to zero in Europe, again pushing the area closer to deflation. And then finally, bank lending standards, which is the bottom panel, that's also tightening. So in the US, we're just seeing all sorts of monetary relaxation, monetary stimulus, and in Europe, we're actually seeing banks tighten their lending standards, which again slows down growth. So all in all, although markets are pricing in no more rate cuts in Europe, I think that the slowdown in growth is going to catch the ECB by surprise. Deflation is going to trickle in, and we're probably going to see some more cuts in the ECB rate than are expected. Now, that means that the euro is probably going to weaken against the dollar. So while the market expectations are for a weaker dollar, the dollar can't weaken any further in a vacuum. It has to have strength on the other side of its weakening. And so far, it has had reasons for the euro to strengthen. But if the EU is facing deflation, and if the ECB is going to cut rates, well, then a weakening euro will stop the dollar from weakening much further. Some of you might say, well, what about the savior, which is the 500 million euro German infrastructure fund? Yes, that will help offset some of that slowdown in growth, but it's likely to take at least 12 months before that is seen taking any impact on the economy. And so it's not going to help in the next 6 months. Plus, we're starting to see the rise of political pressure again in Europe. The French government looks like it could lose another prime minister over the debt situation. So the latest prime minister has called for a confidence vote in the government, which is happening on the 8th of September. And it's very likely that he's going to lose that, just like the last prime minister did before him. Not quite sure why he's so concerned about fiscal austerity, because no one else is in the world. Everyone else is just spending and trying to prop up their economies. Yes, it's great for him to try and be not just conservative, but I suppose just being prudent in terms of the amount of debt that France takes on. But looks like he's going to lose that bet. So with slowing growth, falling inflation, rising political uncertainty, China grabbing some of Europe's market share, we think that Europe might have done its bit for the year. Now, when it comes to our global exposure, we aren't overweight the US relative to Europe, and we aren't overweight the US relative to Japan either. We're neutral within the developed markets. We are still overweight emerging markets, but if we do move back into developed markets, it would be actually in the US rather than Europe and Japan. Still too much deflation in those markets for us to get excited about what they're doing. Yes, they are cheap. There's no doubt. The euro is cheap, the yen's cheap, European equities are cheap, Japanese equities are cheap, but for a reason. Their productivity just is very, very low, whereas the US productivity continues to rise. Even with all the issues that are happening, all the tariffs, US productivity continues to rise. The US is still seeing the biggest investment into R&D, the highest capex for AI, which should lead to further gains in productivity and just the cleanest shirt in the laundry basket, as they say. So no, we're not fans of Europe at the moment, is the summary.
China is right now the biggest revenue line in the tariff income. So, if it's not broke, don't fix it. We have had very good talks with China. I imagine we'll be seeing them again before November. They have a 10% tariff on us. They have started shipping the rare earth magnets, which we agreed to. We had put some countermeasures on them that we've taken off. So I think right now the status quo is working pretty well.
It does seem to be working pretty well. China has definitely seen an improvement in their relations with the US that the rest of the world is lacking, to be fair. And I think the reason for that is China just has the tools to negotiate, particularly with their rare earths, which Scott Bessent mentioned as an very important factor for the US. We are seeing the US trying to online mining of rare earths around the rest of the world that they want to try and grab in Ukraine, for example. But for the moment, they are very dependent on those rare earths. So what we're seeing, Trump has paused secondary tariffs on Russian exports to China. While at exactly the same time as pausing it to China, he has added an extra 25% tariffs to India because they're importing Russian oil. So where the logic in that is, I'm not sure. But India, we're going to penalize you because you're importing Russian oil. China, it's okay, you can import as much Russian oil as you want. It can only be because China can negotiate that. Not only that, but Trump has extended the current tariff truce with China for another 90 days. So that's until the 10th of November, and it paves the way for a potential Xi Jinping-Trump summit later on this year. So we'll be watching that quite closely. Now, as I said, India doesn't have the bargaining power that China does, and they are now at 55% tariffs against the US, which is a problem for India because India's largest export partner is the US. But we also have just seen photos yesterday of Modi hugging Putin. So is India being forced towards Russia and China because they're giving up on the US and they can no longer trust the US? I mean, that is certainly a concern. When it comes to all this rebalancing that Trump is trying to do, if he pushes too hard, he's going to move the world from a multipolar environment to a bipolar, with certainly the US on one side, China, India, Russia, I suppose all of BRICS on the other side, and Europe maybe torn between. Certainly some European countries are siding with China, some are siding with the US, so we might see a split Europe, or Europe favoring the Eastern Bloc. So it's very, very interesting moves out of that BRICS region. Not only that, but Xi Jinping is currently today hosting a 2-day summit in China where he's called upon regional powers, including Russia and India, to join China in leveraging economic influence against the US. Well, he didn't say against, but to balance the US. So definitely looking at a more bipolar world, which is not a great place to be, but I suppose that's where we are. When the US looks so much inward, it forces everyone else to have to look after themselves without the US. So not a surprising result, but a cautious one. Now, when it comes to China, we still think that China is the brightest spot in emerging markets. We haven't yet gone overweight China compared to the rest of the basket, but it's definitely driving the EM performance. Why? Well, they continue to stimulate the economy. For starters, they are basically doing QE. So fascinating chart on the right, the blue line shows the People's Bank of China's assets. And you can see those growing very nicely in terms of dollar assets. And that means that they are effectively buying assets, they're growing their balance sheet, which is what quantitative easing is. So China doing QE, they've cut the reserve requirement ratio from banks, which once again stimulates the economy. They've cut interest rates, which stimulates the economy, and they've had additional liquidity injections into the markets, which stimulates the economy. Not only that, but we've seen that feed through into credit creation. So total social financing, which is the big measure in China, that's providing some upward momentum to equity markets. So the bottom panel of the chart there shows TSF in red. That's picking up nicely and driving the stock market up as well. That's the blue line. Now, China's also, that's not just monetary policy, but fiscal policy continues. And is now expanding at the fastest pace in 3 years. So China doing what it needs to in monetary policy, China doing what it needs to in fiscal policy. And people might say, oh, and certainly when it comes to our debate, and we are still debating this in our investment committee, but China is still facing deflation. Property market is still not turning around. The Chinese consumer has got the highest savings level in over a decade. So, things are very conservative there. And China really falling into deflation, which means the Chinese consumer sitting there saying, well, if I can buy the car at the end of the year for 10% cheaper than buying the car now, why would I buy the car now? That's effectively your deflationary spiral, which is the problem that I suppose the antithesis of capital markets and capitalism. You can't afford that to happen. But we're starting to see some of that reversing. So while the Chinese consumer is sitting there going, I've got negative equity in my house because my house price is falling, and I'm earning nothing on the bank, they're now starting to see that the stock market is at a 4-year high. So we've seen over the last 3 months the biggest switch in over 3 years of Chinese retail investors moving money out of their bank accounts and into the stock market. Now, that is not only good for the stock market, because obviously it'll push it up, but it's very, very good for the wealth effect of the Chinese consumer. Because if the market continues to rally, then the positive equity that they have will counter the negative equity they have in their house, and they'll suddenly feel more like spending. If your money in your stock market has doubled over the year, you go, well, that's profit. Let me spend that profit and I'll buy a new car. Even if the car might be cheaper in a year's time, I feel like I've got that extra wealth and I've got that profit. So, we're definitely starting to see some important things happening in China to drive the consumer to start spending more. Now, the other issue is actually quite ironic. Although emerging markets do very well in a weak dollar environment, that's because commodity prices rally, and that's because it reduces the cost of dollar funding. We are starting to see some strains when it comes to emerging market and even Japanese exporters. Japanese car prices have been cut 10% in domestic prices in yen. Likewise, South Korean car prices have been cut in their domestic currency because these exporters are trying to keep the prices that they are selling to the rest of the world flat in those domestic currencies. So the dollar has weakened. Suddenly, a car would cost 10% more out of Japan. So you want to buy your Lexus in the US, but it's going to cost 10% more because the yen has strengthened or the dollar has weakened. So Toyota has to cut their car prices in yen terms by 10%. It's not good for yen profits. It's not good for Toyota profits, that's for sure. And that's without tariffs. So even though the US is seeing Toyota cars come through at constant dollar prices before tariffs, that's with Toyota cutting their prices by 10% to offset the currency. And then the US consumer is now seeing those cars cost 15% more because of the tariffs. So there's the double whammy that is happening there, and it is certainly a headwind to Japan's exports and to some emerging markets exports. Now, again, why China looks good is because their currency is pegged to a basket, including the dollar. So it's not weakening as much as the rest of emerging markets. It's not strengthening as much as the rest of emerging markets are against a weak dollar because of that peg. So lots of reasons why China is actually looking like the strongest EM in that region for the moment. And we continue to get closer and closer to switching some of our emerging markets into an overweight China, but we haven't made that decision just yet. Okay, so on to South Africa. So a very interesting piece in Signals yesterday from Professor Haroon looking at gold, and certainly gold and platinum. In fact, platinum has 3 times impact on our terms of trade than gold does, but certainly some positive news to South Africa because of the precious metal prices. Now, unfortunately, despite the rest of the world treating South Africa well, we're getting a tailwind despite ourselves because of these commodity prices, we still have some headwinds. Now, one of the biggest ones is the 30% tariffs on South Africa, and we haven't seen any steps towards negotiations to improve that, unfortunately. So it's still very little happening there, besides government finalizing a package to support those companies. And while that is great for those companies are hit by tariffs, that effectively means that you and me, as taxpayers, are going to be paying for the tariffs to the US, which is exactly what shouldn't be happening. We shouldn't be subsidizing the US consumer. Or let me put it this way, you and I can't afford to subsidize the US consumer. But anyway, what we need to do is get those tariffs negotiated lower, but they haven't. Not only that, but NERSA has just approved higher electricity prices for the next 2 years, both years seeing more than an 8% increase in power, which is just tragic because once again, it means that our productivity is falling relative to the rest of the world because we've now got more expensive power compared to the rest of the world. We become less competitive. Our productivity falls because our unit labor costs go up. And then our growth just falls again. So it's another reason why our growth is going to be stuck in this low growth 1% region. And while we remain strategically underweight South Africa, even if in the short term we like SA because of the high commodity prices. So let's focus on the Rand because I haven't talked about the Rand for a while. And there was some great research out of RMB this month that just talks to the Rand. Now, the Rand has recovered quite nicely. It's gone from a low of 19.5 to about 17.5. And so 2 Rand stronger than its weakest level. RMB estimate the fair value of the Rand roughly about where we are. 17.5, they say 1780. Now, they say the Rand could be as strong as 1550. And that's a number that I've also said before. If you look purely at the terms of trade, if you look at purely where the iron ore price is, the copper price, the gold price, the platinum price, palladium price, the Rand could be a lot stronger. But RMB's research have said that in the past, although the Rand has reached 2 standard deviations stronger, so right now we're about fair value, 1780, the Rand has been stronger, 2 standard deviations stronger in the past. That happened in 2005, 2011, 2018, 2021, and you can see those terms all in the table below. Now, every one of those times, every one of those 4 periods had very similar economic environments. You can see the dollar was weak across all of those, whereas the dollar is not quite weak at the moment. Well, certainly it's probably average, maybe even quite strong. I mean, it's not as weak as it could be. The renminbi is strengthening, so that's fine. I'm going to focus on the ones that we aren't seeing that we've seen in the past. So the dollar is not as weak as it could be. The US is definitely not as strong as it needs to be. So the Rand only really gets much stronger than our fair value when the US is very strong. Strong leading indicator, strong non-farm payrolls, that's not happening. And that happens in an environment of low Fed rates, which is also not happening. And the same for South African rates, also while falling, not low. But I think the most important aspect is the bottom one, is SA economic growth. The most important number for me when it comes to analyzing a relative strength of currencies is not inflation. It's not the purchasing power, because inflation is really kind of a secondary impact. What's important is productivity. If you're productive, then you can produce a widget cheaper. Help my English. You can produce a widget cheaper than your competitors, which means your currency can actually afford to strengthen to balance out that strength. Now, South Africa has got appalling productivity, and our growth, well, GDP growth, is made up of labor supply growth and productivity growth. And with us only seeing 1% growth, you can obviously assume that we've got very, very poor productivity. And it's hard for us to be productive when we're seeing such huge increases in all the controlled costs. So we're seeing high increases in rates, particularly, as I said last month, if you're in Cape Town, most of us are seeing a 20% increase in our rates. Electricity has gone up massively over the last 5 years. Water has gone up massively. So when companies are seeing these huge increase of costs, and that's even excluding the fact that many of those companies have had to start providing for themselves, sinking boreholes, getting solar panels, whatever it may be, it just makes South Africa less productive. And when we're not productive, and we do have labor issues and labor union issues, which again makes us less productive. we don't grow and our currency can't strengthen. So yes, there is some nice momentum that is favoring the rand because of commodity prices and because of the commodity prices pushing our terms of trade. So there's a chance the rand could get as strong as 17. Highly unlikely to get to 15.5 because of our weak growth, but it could get to 17, possibly just on a slightly weaker dollar. But then it's more likely than anything else to bounce back because despite South Africa, we still have our own risks. The GNU is a risk. As I said, our tariffs are a risk. And then, of course, there's a chance that US inflation could rise more than expected, which could see the Fed not cut rates, which would see the dollar strengthen and the rand weaken. So overall, I think this is a really, really fantastic model from RMB. I think it gives us a nice overall idea to say that, yes, the rand could strengthen and probably should strengthen to 15.5 because of the commodity prices. But given our weak productivity and given our weak growth, well, we're just not going to get there in this environment. And we probably have seen we're pretty close to the lows. Another interesting data point, and it is just a data point because it's a moving number, but my colleague Ian pointed out that over the last 10 years, the rand has only depreciated by 3% against the dollar. So that means that we're certainly by no means in a weak rand environment from that perspective. Now, over the last 20 and 30 years, the rand has weakened about 5% per year. So over the last 10 years, the rand is actually stronger than average relative to the dollar. So, I would say a fair value is probably, we're not going to see much lower than fair value at the moment. Brilliant. So that brings us to our final slide, which is the positioning. We are moving into a rather volatile month. As I said before, September over the last 10 years has been the worst performing month, and on average actually been negative, and for global equity markets. We've also got some big risks with the September interest rate decision out of the US. Yes, they may cut rates by 25 basis points, but if they don't look more dovish than that, the markets could react quite badly. We also have a US inflation number, which could spike to the upside. So those are all risks. Meanwhile, we have the slowdown in growth that I've been talking about for quite some time. We had expectations of Liberation Day tariffs in April. That forced everyone to quickly import as much as they could. And then those tariffs were delayed until the 7th of August. So that gave companies even more time to bolster their inventories and import more than they could. We're likely to now see that slowdown past August flow through into manufacturing and global growth. And we're already seeing that happen in July and June. So the chart on the right just shows that EU industrial production fell 11.4% in June. I mean, that's a huge collapse, mostly in pharmaceuticals and mostly focused in Europe when it comes to overall global slowdown. EM's looking a bit more protected, as you can see, that's a dotted line, EM, Asia, ex-China, India, and we're talking mostly Taiwan and Korea, given the strong chip manufacturing, so that seems to bolster the rest of EM. And there's another reason why we do continue to like our overweight in EMs is that R&D spend and that CapEx spend from the US on chips, semiconductors remains at record highs. So that's going to continue to drive growth. And another reason why we also don't see a recession happening anytime soon, even though there's a slowdown. And I do think that slowdown is coming, as can be seen in this chart. But it's more in the rest of manufacturing, whereas chips seems to be, again, the one cylinder that is driving growth. So we've got new tariffs from the 7th of August. We've got rising input costs. We've got depressed business sentiment. All expected to see a slowdown in manufacturing activity over the next few months. But the primary driver of our outlook is the US inflation number. So we're going to be monitoring that very quickly. Now, despite our concerns about that, despite our concerns that both immigration slowdown in the US and tariff increases could see higher inflation than expected in the US, for now, we are not fighting the Fed. We remain overweight equities because of the huge support of monetary stimulus from the Fed and the huge fiscal support around the world that is keeping markets growing. But we're very nervous and we're watching things pretty closely, and we will have to see as that data comes out over the next 2 weeks what happens. But I suppose the summary is no change to our views because the data has been consistent with what we've been expecting. More stimulus from the Fed and more stimulus from the governments that are keeping markets rolling across the world. Okay, so that's it from the positioning. Let me give a quick update on the plus funds. So I don't know how many of you were able to join the Bitcoin and Plus Fund webinar a few weeks ago, but our Plus Funds have been open for just on 6 months. In fact, the 6-month anniversary at the end of August, so on Friday, and the funds have been doing phenomenally well. We've had over R500 million flow into the funds in the first 6 months. That's just a record inflow for us. And as a result of the huge demand, we've actually opened up the Sygnia Life Dollar Cash Plus Fund and the Sygnia Life MSCI World Plus Fund to sinking funds. So that's policies, 5-year saving fund policies, and retirement annuities. So now, if you're on our platform, on the Sygnia platform, you can switch some of your retirement annuity, or if you've got a sinking fund policy, you can switch some of that out of, say, for example, our SIG World ETF into our MSCI World Plus Fund, and that allows you to get not just index tracking, but index tracking plus 60, 70 basis points because of that portable alpha. And that's just a fantastic story in a low growth world. If you think that global equities are going to give you 5%, well, an extra 60 or 70 basis points is like an extra 12, 13% return. That's really, really exciting. And certainly we are seeing some very strong demand for that. Likewise, if you have your retirement annuity or even your living annuity on the Sygnia platform, and you are concerned about a growth slowdown, well, then you can switch into the Dollar Cash Plus Fund. And that is doing phenomenally well as well. So that, it's only been 6 months, but on an annualized basis, and I know I'm not supposed to do that, but if you have to annualize that return, the Sygnia Life Dollar Cash Plus Fund is giving you a 5% return in dollar terms. So dollar returns, dollar cash plus 5% is more than you can get from the stock market. And you're getting that in that fund as a result of that portable alpha. And just to remind you, that portable alpha is very low risk. We're just taking money market returns and we are porting that onto our underlying passive indices to get a bit of alpha. So very nice returns. MSCI World Plus Fund on track for 60 basis points alpha over the last 6 months annualized, and MSCI and Dollar Cash Plus Fund on track for about 5% alpha over the last 6 months. So those funds are looking great, and please think of them when you're putting together your model portfolios or your retirement annuity or your living annuity. It's very nice to diversify your portfolio, and there's the added benefit, as you can see from the third column, that you can put up to 100% global into those funds. Obviously, you still have your Reg 28 limits, no more than 45% global for your RA, but there's no Sygnia specific limit in terms of that cap. Whereas other global funds like Berkshire Hathaway and OSE, so you still are limited to 40%. So very exciting, and we thank you for all the support. We really are very, very, very grateful for that huge inflows. I think the funds are fantastic as a core for any long-term investment, and very, very excited to open it up to other wrappers. Okay, that's us for today. I'm going to move on to Q&A. Okay. First question. can Sygnia create a fund to tap into all the increases in the munitions globally so that those who wish to invest can? The war is going to be ongoing for a minimum of 5 years, if not longer. Anonymous, that is a great question. We have certainly looked into that. One of the things we looked at was an EU defense fund. iShares, BlackRock iShares have just launched an EU defense fund. So we did, I think it's been live for about 6 months. We did look at that. It is up 400% over those 6 months. And it's dominated by one share, which makes up 20% of the fund, which is up even more than that. So we do think that there's probably not a great entry to that. Another option is US defense. Not looking as expensive, and the US is still the primary beneficiary of the war in the Russia-Ukraine because they supply most of the weapons. So that's something that we could look at. However, our current strategy is, and I mentioned, I think 2 webinars ago, there's a very strong correlation between defense spend and commodity prices. So whether it's because weapons need a lot of copper and rare earths to be produced, or whether it's because the destruction that happens because of war needs a lot of commodities to rebuild those cities, commodity prices tend to be very correlated to war. And so a much cheaper way of being exposed to that is certainly just staying exposed to SA equities, and China and emerging markets and those commodity prices. And it is one of the reasons why we remain overweight South African equities. We remain overweight emerging market equities to get that commodity and resource exposure, as well as obviously the weaker dollar, which does help both emerging markets and commodity prices. So at the moment, in a nutshell, at the moment, no plans to launch a defense fund specifically yet, because we think it's very expensive. But we may do so in the future. For now, we are just investing in emerging market equities, SA equities, Chinese equities, as a proxy for that through the commodity basket. Hassan says, based on the information shared and the changing regulatory landscape of the crypto environment, what is the prediction for the Bitcoin fund of Sygnia based on the adoption of Bitcoin over the next 1 to 3 years? So I think that's probably the hardest question that anyone could ask me. But the hardest question used to be, what is the currency going to do? The currency is still very, very difficult to predict. I've given a fair value, but I haven't actually given you a direction, more than to say it could weaken if there are risks and it could strengthen because of strong commodity prices. Bitcoin, I think, is even more difficult to try and forecast. And if you look at the forecasts that are out there from strategists, they range from as high as $1 million from its current 109,000, whatever it is, down to $5,000. So a wide range of estimates based on whether you are a believer in a blockchain and Bitcoin or not a believer. So I don't have a prediction for you. I do agree with what you're saying, that the demand for Bitcoin is going to continue in the short to medium term because of funds like the Sygnia Bitcoin Fund, which taps the BlackRock iShares Bitcoin ETF, which allows institutional exposure. So we're seeing pension funds, retirement funds, preservation funds, all being able to now access, well, not in South Africa, but endowments at least, being able to access Bitcoin, and that's driving demand. Whereas we could be seeing some of the traditional investors getting out as the correlation rises. Because the thing about having institutional investors invest in Bitcoin is that it drives the correlation to 1. Because when there's institutional investors sell, well, they're going to be selling all the assets together, or they're going to be rebalancing all the assets together, and that will see Bitcoin being less diversified or more correlated to other asset classes. So I agree with you, some institutional demand coming through. Very hard for me to forecast what's going to happen. I will say, and I've said this before, I think what's driving the gold price and the Bitcoin price is excess liquidity, which is effectively excess money supply in real terms. That's money supply growing faster than inflation around the world. And that's driven by loose monetary policy and a very strong fiscal policy or government support. So I don't think that's going to slow down anytime soon, unless inflation forces the Fed to tighten policy. So our current view is everything is going up effectively. Bitcoin, gold, equities. We just prefer to be in equities because at least there's an income stream backing those equities. Andre says, bubble, bubble. Are we and S&P 500 in trouble? Any view with regards to in which diversified global index funds we can invest in over the long term? Andre, I definitely would say that we have some exuberance in our markets. Whether that's irrational, I don't actually think so, because the fact that people are worried about the Fed and other governments in the world cutting monetary policy, cutting interest rates when inflation remains high, or just the huge amount of printing that governments are doing around the world. When there's that much printing going on and that much low interest rates, well, that does lead to inflation. So is it irrational exuberance that's driving equities and inflation and gold and platinum and Bitcoin? I don't think so, but I do think it's exuberance. And I do think that if there wasn't a concern about governments printing money, then yes, this would be considered a bubble. That current valuations would be considered irrational. But given that governments are being irrational, their markets are being forced to be irrational just to try and protect themselves from the governments. So how long this continues depends on how long governments continue to be irrational. If we see some sort of, again, Fed focus on tapping down inflation or controlling inflation, or we see the Fed being more independent and less open to control by Trump, well, then we could see the current bubble unwind quite a bit. So, currently, I think the bubble is going to continue until governments decide otherwise. And so, we are sitting on that trend train for now. And that's why, although we are not fighting those governments, not fighting the Fed, we are rather nervous because there is exuberance being forced to be priced into these markets. It's effectively kicking the can down the road, effectively bringing forward future returns so that when this eventually all balances out, we're going to have a decade of just zero returns. So, it's very, very worrying. John, pleasure. John asks, with the predicted decline in the euro, what will the impact be on the value of Eurozone equities? So, John, this is also a great question. Part of the reason why I think the euro is going to weaken is because of not just low inflation, but low growth. And the reason that the reason inflation is low is because growth is not driving inflation. And why is the growth low? It's because productivity is low. Europe remains, even with the US growth having been downgraded 1.5% this year because of tariffs, European growth and Japanese growth remain below the US. And that's primarily because European and yet Japanese productivity is below the US. The US is just the most efficient, capitalistic market in the world, and its productivity continues to rise in absolute terms and relative to the world. So it's hard to get excited about other equity markets when the US is just so productive and leading that productivity race. The one market that could counter it is China, because they have the second highest R&D spend in the world, and because they have the second strongest AI research in the world. So that both of those could drive some productivity gains in emerging markets and in China. But it's difficult to get excited about European equities right now, given the growth outlook. There's also the concern about tariffs, particularly we haven't sorted out the tariffs in Switzerland, still sitting with 39% tariffs. So those could be another headwind to Europe as a whole, even though Switzerland doesn't make up the stocks. Well, Switzerland is not part of the stocks 50 index, but it is another headwind for European equities as a whole. So we don't think that we're going to see much stronger returns, out of Europe. Louise says, global equity markets have been running so hot, surely a market correction is overdue. Louise, I agree with you. A market correction is overdue, but I think it all depends on what's driving that and to what extent that is driven, to what extent that news is structural. So yes, markets are hot, but they are hot because they're being forced to be hot because there's no way else to hide because of inflation concerns, because governments are printing money. If we have a small increase in US inflation, maybe markets have a small pullback, a breather, and then carry on running. But if that inflation gets hotter and hotter and hotter over the next 3 or 4 months, markets could actually see a much bigger correction. So it all depends on the data that's going to come out. Anonymous says, please comment on NVIDIA. Anonymous, we actually are going to be doing, I'm going to be doing a FANG.ai fund interview with our product specialist, Bella. That will be in the next few weeks. So hold on for that. I had some very interesting insights into NVIDIA. You would have seen that the results have just come out. They are seen as the bellwether for global technology stocks. Because they are so important from a chip perspective. They really are the core to the AI data centers that are being rolled out across the world. They are the core to Trump's Stargate project. They are the core to the H20 debacle in terms of the chips that are being imported into China. So they're very, very, very important for the US economy, as is TSMC for Taiwan. Investor pointed out today that half of Taiwan's exports to the US are from TSMC chips. I mean, it's just incredible how chips are such a huge commodity across the world in terms of the value that's being traded every day to drive that AI data center. So NVIDIA results were solid, slightly better than expected. Probably not as good as some people hoped. I think there was some hope that they would be exceptional. So the price did dip a bit on the day, but I think they're basically good enough, solid enough to keep the technology market running, which should keep the FANG stocks running, which should keep S&P 500 running, and then NASDAQ running, which will keep MSCI World running. So again, another reason why we're happy to be overweight equities is that no bad news yet out of NVIDIA, although very much politically driven with Trump taking a 10% stake in Intel and Project Stargate and 15% tax on NVIDIA's chips to China. Just so many moving parts. Really is a fascinating story, NVIDIA. Pleasure. Good. A question on the Sygnia Divi Fund from Kestel. I haven't seen a question there for a while. The question is the Sygnia Divi Fund positioned for a year-end rally supported by resource strength and the potential re-rating of the financial sector's relative value? Kestel, the Divi Fund has definitely been improving on the back of resources. It did have a tough year, but it is looking well positioned if those resource stocks continue to rally, and if other high dividend stocks continue to rally. So we'll see. It all depends on whether those dividend stocks do well. But at the moment, it looks like there's some momentum behind that value play on the dividend yield. So yeah, more than likely it will carry on doing as well if the trend continues. Greer says, there seems to be a one-sided view on gaining alpha from the companies profiting from the conflict, specifically in the Gaza today, not including Ukraine here. What would you say to shareholders exposing themselves to future litigation risks when the dust settles? I mean, that's a fantastic question. We've certainly seen a big debate about a number of inclusions into socially responsible funds. The one has been nuclear power. That was excluded from social responsible funds, and that has seen a huge increase since the Russia-Ukraine war. Nuclear power, despite the risks, environmental risks now being seen as responsible, as just because it's more responsible than investing in Russian companies. And certainly we are seeing some SRI funds include defense companies, because it's seen as responsible because it allows countries to defend themselves. So this topic is definitely a lot more debatable than it once was. But I hear what you're saying. I think, I mean, long term, there are definitely litigation risks. You know, I think the debate has got merits on both sides. And I don't know which side I would actually currently settle. For the moment, people are just really not even looking at SRI funds because Trump doesn't believe they're necessary. So it's the focus is everywhere else but social responsible investing. Great, nearly done for the day. 2 more questions. Mandy says, just want to know why Tesla is not part of the FANG, seeing it's growing as the leader in the air. Mandy, Tesla was part of the FANG index, but it was replaced by a number of the chip stocks. So at one point, I think it might have been AMD that replaced it before AMD itself was replaced by Broadcom. So Tesla hasn't been in that index for quite some time, and we prefer to only include shares that are in the NYSE FANG index when it comes to that portfolio. But Tesla is definitely in the Fourth Industrial Revolution Fund. It's got quite a decent weight there. So if you want exposure to Tesla, then the Fourth IR Fund is the place for you to be. And the last 2 weren't questions, they were just thank yous. So absolute pleasure. It is fantastic seeing you all once again. Thank you for investing in Sygnia. Thank you for trusting us with your time, with your money. I really appreciate you joining, and all the best for September. I do believe it is going to be one of the rockier months, and before we get into the year-end positive trend. So hold tight, and yeah, I'll see you in October. Have a great month.